The 2023 tax deadline is approaching, and Celsius has been refunding and releasing to prior investors and customers parts of their initial investments. So what does that mean from a tax perspective? Is there a tax loss that should be claimed? And what should you do before the tax deadline? These questions have been coming to me every single day. My name is Andrew Gordon. I'm an attorney and CPA. I've been practicing in crypto tax since 2014, so over the last 10 years. And I've seen most things, but I haven't seen everything. This Celsius question is something that I see time and time again, and if you watch this video, you'll hopefully know what to do next. And so, to date, Celsius has refunded to investors a portion of their initial investments. In many cases, it sounds to be somewhere around 30%. And the tax deadline for 2023 is April 15th, 2024. If you're watching this, it's coming up soon. And so is there anything you need to know? And what should you do before the tax deadline? Well, if this was back in 2017, it would be fairly easy to take a theft loss deduction. Back then, the tax code provided that if you had a loss due to theft or what's called a casualty loss, you could take a deduction and it would be an itemized deduction. Fairly easy to take. But after 2018, this deduction was no longer available. In fact, in order to take a theft or casualty loss deduction, it needs to occur in a federally declared disaster zone. So in the case of crypto and these types of situations, that just doesn't apply. So we have to look beyond that for other potential deductions. And one that people and practitioners have been considering when it comes to crypto and specifically Celsius is the Ponzi scheme deduction. And so Congress several years ago, after the Madoff Ponzi scheme, created a new deduction and a safe harbor for it that allows victims of Ponzi schemes to take a deduction on their taxes. And the IRS released what was known as Rev Proc 2009-20, and on that provided for certain safe harbors or the ability to take a certain portion of the loss, but it had to be taken as long as a Ponzi scheme occurred and that it was a investment and that it needed to be taken in the actual year of discovery. And so in the case of Ponzi schemes, this is typically the year that the person is indicted or charged. And when we're talking about Celsius, the CEO of Celsius has been indicted on certain charges, while not directly Ponzi, seem to be of that type where it's a fraudulent investment scheme. And so many practitioners do believe that the indictment of the CEO of Celsius does provide a stronger argument for a Ponzi deduction. So how much do you deduct and when do you deduct? And that's where things get even more complicated, because for most people, you got some of your tokens back, but you didn't necessarily get back the original types of tokens, and you certainly got a different amount back. And so we're all struggling as CPAs and attorneys with this question right now. How do we calculate the amount of actual loss for what you didn't get back? Because Celsius has returned Bitcoin, Ethereum, also has provided shares of a new company. And we've got to value all of this. One position is that your cost basis just carries over. And so there is no capital loss. Your cost basis just carries into the new tokens you receive. And so if you wanted to receive record a loss, you would sell those tokens. So for instance, if you had $100,000 of Bitcoin and now you receive 0.5 Bitcoin back, the cost basis of that 0.5 would be $100,000. So if you sell it tomorrow, even at an all-time high, you'd still have a loss because your cost basis was higher. And that's one view, which is that no loss occurs, your cost basis just carries forward. Another view is that there is a loss because you got less back, and that could be either capital or potentially a Ponzi loss. But going back to the revenue procedure, Rev Proc 2009-20, it talks about safe harbors, and it provided a 75% and a 90% safe harbor, meaning that you could take a deduction for those percentages of your loss in that year that it's discovered, our case likely 2023, because there's the expectation that you're gonna get something back. And so if you got too much back, you'd have to report that as income. And so these 75 and 90% safe harbors allow you to report less, and that way when you get some back, hopefully you don't have an income situation. But with Celsius, it's even more confusing because the typical person that I speak to got at least 30% back, and that's not even including the shares from the new company. So if we were to take the Ponzi safe harbor of, say, 75%, you might be in a problematic situation. And that all just assumes from the beginning that the Ponzi deduction even applies to our fact pattern here. And so the advice that I'd give potential clients is, first of all, it might make sense to file an extension. The 2023 tax deadline is fast approaching, but there's still uncertainty, and this is developing. And so to provide us additional time so that hopefully there's guidance or more clarity from firms such as myself or ourselves, an extension will allow till October 15th to file the tax return. Not to pay, the deadline to pay is still April 15th, but that way you have some more time to file and actually take a certain position. And that's likely advisable because the Ponzi deduction itself, not very clear cut that it applies to crypto losses, especially Celsius. And so if you're in a situation where you've had sizable losses from Celsius, it may make sense to get a tax opinion letter from a professional. You may hear all different opinions online, and if just because someone says something online doesn't mean that it actually can be used in case you are audited to defend your position. The IRS isn't going to hear what you heard online. And so an opinion letter from a tax professional is a written opinion on a certain topic. In this case, the Celsius loss and whether it applies to the Ponzi deduction. And so by getting an opinion letter from a tax professional, that generally provides protection against penalties in case of an audit and the IRS says that you're wrong, that it doesn't apply for your situation. So an opinion letter is a way to actually get an answer, get a solid response from a professional that you can rely on. It doesn't mean, again, that if you're wrong, that the IRS will say you don't have to pay tax. You still have to pay tax. But penalties, which is often a very large part of the overall tax or the overall balance, wouldn't be due. So if you're considering that as an option, consider an opinion letter. I hope that this video has been helpful to you. If it has, please share it with a friend. There's a lot of people that are victims, unfortunately, of Celsius, not only victims the first time and the loss, but now also going to be in a negative position because they don't know how to deal with this situation and even take advantage of the potential loss. So if you know someone that might benefit from this, please share it with them.